Okay, what we're going to do is take the entries that we did earlier in 3.2. These are typical transactions that occur during the month of May for this company. And then what we're going to do now is post all those entries to the ledger. We're going to take it from the top. You see here we have a debit to inventory, so we go to the inventory account and we're going to debit that account. So you got the 2200 debit. Then the next is accounts payable. It's a credit, so we'll put 2200 on the credit side for accounts payable. Entry number 2, we have cash being debited, and the credit is to notes payable. Number 3, we have a debit to equipment, so we'll go to the equipment account and debit it, and then the credit is to cash, so we'll go up to the cash account and credit cash. Number 4, we have a debit to accounts payable. The other side, we gave up cash to pay off our bills. And number 5, we have a debit to cash and a credit to accounts receivable. What we're getting is cash, and we're giving up another asset, the promise to receive from customers. The 24th of May, or transaction number 6, we have a debit to accounts receivable. We're getting a receivable from our customers for goods, or in this case goods that we delivered. What we're also having to debit though is cost of goods sold. That's representing the amount of inventory used. Expenses are the using of assets or the getting of a service. Now the other side of the credits are to sales, which increase our shareholders' equity, and the other is a credit to inventory, which is going to decrease inventory. Last entry here is we debit dividends and credit cash. So that's the posting process. It's just copying. So the hard part is coming up with the entries. Once you do that, it's fairly mechanical. Now what companies will do is at the end of the accounting period, they'll get their running totals. So we have cash. When you tally up, you got beginning cash of 5,000, add your debits, subtract your credits, and you get 9,200. Accounts receivable 5,000. The inventory, when you add your debits and subtract your credits, you get 500. We have done nothing to the prepaid insurance, so it's still 750. Equipment has grown to 12,000, and our accumulated depreciation is still 7,500. Let's go to our liabilities, tally up our liabilities. We have 2,200 that we still owe. We have interest that we still owe. That's from borrowings from the prior period that we owe interest on. And now in this entry we have, or excuse me, in this account we now owe 19,000. We had owed 11,000 from earlier, and we've now given out more IOUs. As far as the equity accounts go, common stock still 4,000. Credit balance, normal balance is a credit. Retained earnings, that's the earnings we've kept of the past. In other words, all the past net incomes and minus all the dividends of the past is 635. Your sales are 5,000. Cost of goods sold 3,500, and lastly dividends of 800. So what we have now are what we call our unadjusted balances here. They're not quite ready to go on to the financial statements. We need to make some adjustments because of the passage of time, and we'll go through that shortly.